All right. So, hi everyone, welcome to Bharat Alternates. Today we are at episode 5 of Fund Manager Talks. So, webinar today's topic of the webinar is Inside Real Estate Yield Funds, Category 2 Alternative Investment Funds, how they work. So, basically, what we do in these webinars, we sit down with all the fund managers, most insightful fund managers, and learn across how they are managing their AIFs and what are their offerings across PMSs, across AIFs, and different offerings that fund managers have. And today we have Mr. Anchit Lakhotiya, who is a fund manager at Whiteboard Millennia Yield Fund, which is a real estate Cat 2 alternative investment fund, which is focused on generating steady, predictable returns from income yielding commercial as well as residential real estate. So Anchit is a chartered accountant by profession. He's having extensive experience in real estate investing, fund structuring, asset management, having worked across multiple market cycles, multiple sectors, and finally now he's having his own fund and he's managing a real estate AIF. So today's conversation isn't about any product promotion, but rather learning about how a real estate AIF in Cat 2 works. Though they have their own fund by the name WB Real Estate Yield Fund, we will be talking about that as well. So let's understand and welcome Anchit. Hi Anchit, welcome and glad to host you.
Hey Gitansh, hi. Thanks for having me on the show.
Welcome Anchit. So if you can spend some time giving a little background about your professional journey, how it has shaped up, and eventually you are managing your fund into real estate.
Gitansh, I started my career as a banker into real estate itself, where I used to do retail home loans and loan against property, on those in 2000 sometime with ICICI Bank. So, which was the peak time when, home loans were growing into India big time. So, I have seen real estate from the ground itself, from the basic stage of home loans. And from there, then I moved into the corporate world of real estate financing to various developers, corporates within ICICI. And then I set up the real estate business for Standard Chartered Bank when they were starting their RE business, where we have done a lot of structured financing across residential, commercial, mall, hotel, various asset classes in India and outside India. And after doing banking, I got experience of managing NBFC capital, which is more near to the alternative capital in terms of structuring and risk. And my last stint before starting Whiteboard was with an entity called Lone Star Fund, which had an credit entity in India. So it has been all the way a real estate journey from the ground of home loans to the structured finance and equity investments structure.
Okay, so basically your career is towards real estate AIF or
Yes,
real
I'm a
estate
career
investing.
real estate banker, investment structuring
Got
and
it.
across
Got it.
segments.
So
Yeah.
right now we see that a lot of AIs are coming into, especially the real estate side. There was an article also 2, 3 days back into Economic Times where a lot of AIs are coming up with their real estate AIs. So our audience includes today HNIs, ultra HNIs. So if you can throw some light so that they can understand from basics how particularly a real estate AIF works, if you can, explain our audience in a very easy and simple terms.
So I'll tell you this way. Look, one is in India, real estate as an industry has a lot of restrictions from regulator for financing because of the inherent nature of the risk and the perceived, what should I say, not non-formal structure in real estate which operate, right? So to counter that risk, RBI and SEBI have been very focused in terms of ensuring that the capital which goes into real estate is only with people who understand the real estate risk. So in that context, lot of financing of real estate is not allowed by banks to be done. That actually leaves a large vacuum for capital to come in to support these real estate growth. Okay. Normally, in the erstwhile era, all the real estate early stage money used to come from friends and families, from HNI offices in informal manner, right? And then banks used to come at later stage when the project is launched, sales is happening, collection are doing. Now, how do you bridge that gap of early stage growth capital in a formal manner and ensure that that capital gives returns to the cash flow which India is generating itself? So AIF is a very large industry which has evolved globally to provide growth capital to every industry, right?
All
So
right.
that is where the AIF role comes into play in real estate in India. It gives a growth capital, and because it's a growth capital, it offers high return along with the risk associated with it. So
Got
hence
it.
AIF has actually becoming one of the larger investors into real estate year on year in India because of the RBI regulations, which doesn't allow bank and NBFCs to fund growth capital.
Got it. So now talking about, because I want you to take from very basics. So if someone is having 1 crore, he can buy a land also and he can invest in a real estate AIF also. So how does that
Mhm.
differentiate if you can, explain it?
So I'll tell you, it's simple as SIP mutual fund thing. Okay,
Okay.
you have a equity market mutual fund. You can
Right.
go and directly buy Reliance, or you can and directly go buy, say, Anchit Lakhotiya and Company if I'm listed, right? But then you are taking a concentrated risk on that particular stock.
Right.
Same is with real estate. When you have 1 crore, you can go and buy one plot, or you can go and buy one house. But then your risk get concentrated, okay, and you have to manage the entire risk yourself. Tomorrow, any issue in the title, when you're selling the project, when you have to find a buyer, right? And you don't know what time will get your money back. So to replace that with a mutual fund similar to direct investing, AIF is like a private mutual fund for real estate, where you give money to a fund manager who has done this business for 20 plus years, right? And he diversifies your money into 10, 20 projects. So even if one project doesn't work, there are another 19, 18 projects to give your money back. And because it is a close-ended fund, right? Most of the AIFs for real estate are close-ended. That means you will get your money within a fixed period, right? So that helps you actually get your returns regularly and within a defined time frame.
Got it. So I just wanted, to take up to our audience that how your AIF is also different from REITs that, anyone can go and buy directly now, REITs.
Right. So REIT is a form of investment into real estate, but only into commercial real estate. Okay.
Okay.
REIT gives you a specific return of 7 to 8%. Okay. And the growth in the REIT is also limited because they distribute most of their returns immediately as per the SEBI requirement, right? Compared to that, within AIF, the typical returns are upward of 12 to 14%. That is one thing. And also, these return can further increase depending upon the type of investment done. So REITs are like near to the FD returns, if I may say. Okay, and more secured or committed because they are near FD returns. The risk is less. Whereas AIF, obviously the risk is little higher, but these are secured returns which are much higher or double than actually the REIT returns.
REITs can give you.
Yeah.
Got it. So now moving on to particularly your fund, which is WB Yield Fund. So if you can throw
Right.
some light how you are exactly working in this particular fund, and if you can throw some
Sure.
background.
So I'll share you one basic sort of template for you to refer. Um, is this visible? So WB Yield Fund is a focused fund to invest into the IT corridor of India. So we are the IT digital business is growing multiple every year on year. And with those sector growing, the housing requirement in those locations is also increasing big time. Right. In India, primarily, if you see South India is where most of the IT work is done. So
Okay,
cities like Bangalore, Hyderabad, and Chennai, these are the core centers for the IT population. Okay. So we are targeting the growth and stable market of IT population and their requirement for residential in these markets.
got it. So basically, the gap that you are trying to fulfill, what in simple terms, if we talk about what is the gap that you are aiming to fulfill with this particular strategy that you are managing?
Right. So what we are trying to fulfill here is the gap of growth capital required for increasing housing requirement for the IT populations in the key markets of India. And what we have done is we have identified a very strong development partner so that the risk of completion of the project, sales of the project is very strongly covered. So Casa Grande is our partner in this fund for developing the projects, and they have a very strong track record in South India. They are among the top 10 developers in India, and they will be sort of working with us to develop and complete these projects and selling them for generating returns.
Got it.
So typically, our fund is a 500 crore fund. It's a Cat 2 AIF. Okay. We will be investing into the residential project and generating a return of upward of 18% on that. Okay. Where we'll be regularly paying coupon to the investors from the cash flows of these projects. Additional to the security of the project where the money is being invested, we will also have guarantee from the A minus rated company of Casa Grande. So it's like a double security which we are working on to give strong return to the investors. And this fund is a 5-year fund.
Got it.
So people who are looking for secured investment with diversification into residential segment for a period up to 5 years, they can comfortably get decent return under this fund.
Got it. And also there are some risk involved like delays, illiquidity. So how does your
Right.
fund, mitigate those operational risks? But obviously risk cannot be eliminated, it can be just
Yes.
reduced. So if you can throw some light on the risks that are involved in particularly these kind of AIFs.
So obviously, as you rightly said, the key risk between these AIFs or these investment are the project risk and the counterparty who is developing the project, right? Because your
Right,
money is going to come out of the completion of the project or sales of the project. So
right.
completion and sales of the project is the primary risk. So to
Okay.
mitigate that risk, what we have done is we have got a top-notch developer as a partner who has a 20 plus years of track record of completing, developing, and selling projects. And we are doing this with them in their core market of South India. So that actually covers significantly the risk of completion and sales of the project from which the money is going to come back. In addition to that, we are covering that even if the project for whatever reason is delayed or stopped, right? We are covering it by a corporate guarantee.
Yeah,
So that if the project is delayed or stopped, then there's a fallback on the corporate guarantee to give the returns and the money back.
got it.
And that corporate guarantee is A minus rated.
Hmm. Got it.
So very good
And
rating corporate guarantee. Yeah.
got it. And how the investor has to pay the minimum ticket size for particularly this AIF is once a year, right?
Yeah, which is as per SEBI regulation.
Yeah, SEBI regulation, and how in what time frame the investor has to pay that once a year, and how will the investor get his principal as well as interest payment or coupon payment back? If you can throw
Right.
some
So
light.
right. Good. So investor will pay this once year in two or three tranches over a period of 6 months, approximately 30% each.
All right.
Okay. The returns will come on a quarterly basis from the end of first year.
Okay.
the interest payout, and then after the third year, the principal also will be start coming back. So the average maturity will be somewhere around 3.5 years of the investment.
Got it. Got it. And what can be the ideal, though in we are talking on a public platform where the ideal set of what is the ideal profile for this particular area? What do
So
you
I
feel?
to get sort of secured yield returns over the next 3 to 5 years. Okay, which can be senior professionals or families who want to have a regular income flow coming in for the purpose of either expenses or for any other fixed requirement which they have year on year. So it is like you can replace a part of your fixed income product with this product to get higher yields.
Got it. Got it. All right. I think we have talked upon fund. Anything that you want to highlight that investors should be aware apart from this?
So typically, whether it is our fund or any fund, I think the two most important thing any investor should be aware about is that uh, the fund returns and risk are primarily based on the approach which a fund manager takes, uh, and that becomes very important whether that risk appetite align with your investment risk appetite.
Right. Correct.
So I think that's what everyone should look at while investing into every fund. And our fund offers return and risk to people who want to have real estate exposure, but diversified and managed by a professional team who has a track record.
Got it. Got it. So maybe Anchit, if you can stop sharing your screen and maybe we can have some general discussions now.
Sure.
So, Anchit, like you have seen a lot of market cycles, and real estate
Mhm.
is something which is a cyclical in nature. And we have seen the real estate bubble also, which busted in 2008. So, what was, if you can throw some light, what exactly happened at that point in time?
So real estate as a cycle, especially from India context, is actually linked to two primary, I'll say, events. One is the equity market movement,
Right.
and second is government policies.
Okay.
Because real estate is part of the infrastructure and the urban growth in the country. So typically, what happens is if certain infrastructure plans of the government are derailed, a particular location or particular market may get impacted because of that. Okay. Now, real estate is not a short term investment which people try to do. It is not a trading commodity. And that is where a lot of people get stuck in the bubble event because they think that, like stock market, we can invest and easily exit ourselves, within 1 year or 6 months by making 10%, 20%, 30% return. But it doesn't work that way. And that is where these AIFs are coming handy now. Because you invest into a property thinking that, okay, if the next flat is sold for 1 crore, I can also sell it for 1 crore. But it doesn't happen that. The demand supply dynamics changes. And in the last cycle, when the euphoria happens, like in equity market, everyone start buying, right? But when the prices are peak,
Right.
here I think one important factor to understand is that whenever one buys a property, the leverage is very important. How much loan you are taking to buy that property for investment,
Right.
because eventually your return has to come out from the property, right? And if you take a higher loan on the property and the markets are not on the side, then it can have a very big impact, which happened in the last bubble because people took very high loans on their properties, and because servicing couldn't happen, then the entire crash happened globally.
And what was your thought process at that point in time? Because you were primarily involved in the real estate segment only.
Right, right. So our idea was that, work that point in time, we started working with people who had a horizon from a long-term perspective, which I said, trading was not the idea always, right? I was very clear that even if today the market is giving 1%, 2% return, if you invest with the right development partner, okay, they will last for long. If you see today, there were, say, for example, 100 developers in the country 10 years back.
Right.
Today, out of 100, only 20 will be left because
Right.
most of them were trading in the land and
Correct.
they've called themselves developers.
Correct. Right.
So, which is what the thesis we do right now also. And when we started our fund, we first thing was a good partner to develop.
Right. And do you use leverage in this particular AIF?
No, no. No. So the SEBI doesn't allow, and we also don't use.
Okay, got it. And what's the fund's view on the interest rate movements, since yields can be also sensitive? So does it affect it?
So obviously, right now we are in a cycle where inflation and all is showing low. RBI is giving signal of either maintaining or reducing the rates further. Uh, the good part is the AIF caters to the growth capital, right? So growth capital doesn't get much impacted by the immediate movement of the interest rate cycle. So, for example, even if RBI reduces the interest rate, the growth capital returns will not get drastically impacted. It will have a very marginal or no impact in that manner.
And one thing we particularly miss that your AIF invest in how many, projects that are going on an average?
So, on an average, our concentration on one project will not be more than 15% of our AUM.
Okay. On
So
one
each
particular
of the
project.
investment will be in that range. Yeah, yeah, yeah. So it is well diversified. So for example, if we are investing 100 crores, it will be across 6 to 7 projects. Yeah.
Right. And how do you see real estate market today in India? Because we see the prices in, if we talk about in prices in Gurugram, the prices are
Hmm.
already, we see 100 crore, 200 crore flat which is getting sold.
Right, right.
So
Yeah,
yeah,
yeah. No, no, so obviously, post-COVID, the entire residential market has changed. We all have seen it, right? But there is a reason to that because pre-COVID, if you see, for last probably 7 to 8 years or more than that, the residential market was very slow. I mean, Gurgaon, as you gave an example, right? You would have seen that the prices which were there in, say, 2010, 12, okay, they have not drastically moved till 2020 or 2019. It is that in 20, when the COVID sort of started, and from there onwards, the entire approach to residence has changed, right? People want more houses, people want bigger houses. Housing has become again a priority, which in some part before COVID, young generation was avoiding housing. They like wanted to live on rent, they wanted to travel out and all. But COVID brought people back into their houses, so they realized, no, I want a bigger house going forward, and that is where I think the current absorption is happening, and it should last a little longer because typical real estate cycles are 7 to 8 year cycles. And right now, we have done 4 years approximately in this cycle. So we still have a runway of 3 to 4 years, I guess. Maybe the prices will not go up so much, but at least the cycle of absorption, supply demand will be good.
got it. So that's where your AIF is trying to play its growth story and take
Right.
advantage of that.
So we
Got
see
it.
that next 3 to 5 years, we are in a decent shape to make reasonable return within this cycle.
Got it. So I think we have covered almost every aspect of overall journal discussion as well as your webinar. So if you want to add something, Anchit, or then I will just give the closing remarks.
No, Ganesh, I think my only thing here is, whether our Millennia fund is there or any other fund from a real estate point of view. Uh, I think it's a very good asset class to invest for high returns. Typically, we Indians uh, are not very savvy when it comes to the investment understanding. People should look at AIF real estate very seriously if they are interested in real estate exposure, because this gives them diversification and professional person handling it.
Management. Correct.
And this
Right.
is going to be one of the largest industries going forward. The way a mutual fund has grown, AIF are going to grow big time. And we Indians are going to get benefited by the high returns through professional management.
Got it. I think, Anchit, you have articulated the entire, discussion on real estate very well. So thank you for your time and thank you for simplifying this yield-based real estate AIFs for our clients and helping our audience understand the depth behind these strategies that and your due diligence that you do. So this conversation was very interesting. Thank you, Anchit, for being a part of the webinar. We'll stay in touch and, we'll connect in future as well.
Sure, sure. Thank you, Gitan. It was lovely interacting and happy investing.
Yeah. Thank you, Anchit. Bye.